In 2025, the arrival of a child triggers a profound shift in financial gravity. According to a landmark study published in the Journal of Risk and Insurance, new parents are 300% more likely to purchase life insurance within the first year, but a staggering 70% of those policies are either the wrong type or insufficient. This isn't about morbid planning, it's the ultimate smart money move. It's the financial keystone that ensures your family's home, dreams, and future remain intact, even if you're not there to build it. Let's dismantle the first myth, the 10x income rule. It's a crude, outdated shortcut. The smart money formula is precise. First, calculate your family's total debt, mortgage, car loans, student loans. Then, add future obligations, 18 years of childcare and a target amount for college tuition. Finally, factor in a buffer for living expenses and final costs. For example, a family with a $400,000 mortgage, $50,000 in other debt, $200,000 for college, and a $100,000 living buffer needs at least a $750,000 policy. This is your family's true financial runway. Analyst, for nearly every young family, the unequivocal champion is term life insurance. It's pure, straightforward protection. You pay a low premium for 20 or 30 years of guaranteed coverage. The data from the Society of Actuaries is clear: a healthy 30-year-old can secure a $750,000, 30-year term policy for roughly $30 to $40 per month. That's an astronomical amount of coverage for the cost of a single weekly grocery trip. It protects the family during its most vulnerable, high-debt years, and then expires when the need has diminished, a perfect financial tool. Analyst, now, let's expose the trap: whole life insurance. Sold as an investment, it combines insurance with a cash value component. The problem? The fees are enormous, often consuming the first year's premium entirely. The historical returns on the cash value are abysmal, often under 3% annually, net of fees, compared to the stock market's long-term average of 7 to 10%. This is a classic case of financial product confusion, designed to generate high commissions for agents, not high returns for your family. Riders are policy add-ons, and only one is non-negotiable for a new parent: the Guaranteed Insurability Rider. For a few extra dollars a year, it allows you to purchase more coverage later without another medical exam, crucial if you have another child or buy a larger home. Skip the accidental death rider: your policy already pays for death from any cause. Avoid complex return of premium riders: they drastically increase your cost and the math rarely works in your favor. Here's a critical and often overlooked calculation: the secondary earner. Even if one parent earns no income, their economic value is immense. Replacing childcare, household management, transportation, and education coordination could easily cost $75,000 to $150,000 per year. A policy on a non-working spouse ensures that the surviving parent can afford to maintain the family's structure without having to take on multiple jobs or drastically alter the children's lives. This is an act of profound financial respect. The application process is your opportunity to save thousands. The rate class you receive, Preferred Plus, Standard, etc., determines your premium for decades. Preparation is key. In the months before your exam, avoid high-sodium foods, excessive caffeine, and strenuous exercise 24 hours prior. Know your family health history. Even minor improvements in blood pressure and cholesterol can vault you into a better class, saving you 20 to 40% over the life of the policy. Analyst, relying solely on employer-provided life insurance is a dangerous gamble. It's typically only 1 to 2 times your salary, far below the true need. More critically, it's not portable. If you lose your job or develop a serious health condition, you lose the coverage precisely when you may need it most and be unable to qualify for a new policy. Smart Money uses employer coverage as a cheap supplement to a robust, self-owned term policy that you control for the full 30-year term. Life insurance is one pillar of a fortress. The full Smart Money protection plan integrates it with disability insurance. You are more likely to be disabled than die during your working years, a legally sound will and guardianship documents, and a fully funded emergency fund covering 6 to 12 months of expenses. This creates a layered defense. If one system is triggered, the others remain intact to support your family's long-term trajectory. The ultimate Smart Money lesson for new parents is this: